Hello everyone, welcome back to the 2026 Portfolio Challenge series. This is the 31st week, and in some portfolios we did really well, and in the meme stock one we did very poorly, and the S&P 500 and the NASDAQ, they did really well this week, and they're actually getting along pretty well this year. So let's get started. Disclaimer, this video is not financial advice. In today's itinerary, portfolio changes this week. That's going to be really quick. And then watch list and macro news, which is going to be mostly earnings reviews. There's not much earnings previews, so just earnings reviews. And then there's both GameStop and Celsius, I believe. They had pretty big news this week, so we'll talk about that. And then we'll talk about the portfolios at the end. So in my portfolio changes this week, my ELF got called away. So we can just go here. So I had, I'm not sure what that is, but I had 400 units of ELF, and I sold a covered call for them for earnings for 90. And ELF ended up closing at 98, so that got called away at 90, and I got 250 premium, so I got 92.5 for them, roughly. I'm fairly happy with that. I think ELF is right where it needs to be. I took the risk, and I'm very happy with letting it called away. So there it is for that. And then the other thing is my GameStop PMCC. So this is in my meme stock portfolio, my poor man's covered calls, meme stock portfolio. And we'll talk about this in a minute. But yeah, I sold some 20 covered calls for this week. And I now have 165 compared to 162 last week. And I'll actually show that over here. Here we can see I've got the simulation of every week, and this is my Monte Carlo simulation based on how much I should have, and hopefully we'll keep ahead of this pretty significantly. But right now I'm at 162, and eventually by the end of the year, I hope to be at around 250. If I can be at 250, I'll be happy regardless of what the price of it is. And I do think GameStop will be coming back, and we'll talk about that later. And then Meta short put, so I put this I did just in my deep value because I had some spare cash there, and I'll probably end up closing this, but I did do it, so I should talk about it. Basically, I did a short put just to see how much leverage Alpaca lets me do here, and so I put a short put for Meta at 550 right there for December, and I got 3,000 for that, and it locked up I think only $8,000 in cash, so that's pretty decent. And I put 550 because that's where the deep value would be buying Meta regardless. So if Meta drops to 550, I would be buying it. So I just put a short put there, which means if it goes below by at December 18th, or at December 26th, I'm actually not sure. Yeah, at December 18th, 2026, then I will be buying Meta at that price, and I keep the premium regardless of 34.30. So that was just to check everything. And now in my watch list and macro news, so I'll start with the reviews, which is AMD, ELF, Celsius, SanDisk, Texas Roadhouse, SharkNinja, and Oklo. Now these three, I did not preview them, mostly because I did not notice that they were actually doing earnings. So that's my bad, but I do like, these are in my portfolio, or my watch list actually. And then we'll talk about GameStop's $1.4 billion private equity convertible for shares and what that entails. And then, so this is just a small thing. Meta was fined about $1 billion. I'm not going to talk too much about that, but that is something that is to note. I don't think that is a huge deal, mostly because Meta makes so much money. The revenue is $228 billion per year. So $1 billion is less than 0.5%. So there's not much to do there. That's just there. And then I did not add this, I believe, because Celsius, but Russell, Savage, and Celsius. So I'm adding that there just to make sure I do talk about that. Okay, so let's get started. AMD earnings review. Not much happened, not much surprise, and I'll show it on TradingView here on the chart, just because it has the earnings estimates and how much they beat or did not beat. And you can see they were within 2% of Wall Street. So this was not the shock and awe that some people thought they were going to have. Not too much happened, but the main thing that did happen is that Lisa Su raised their future estimates, which are humongous. So that is, I think, very bullish. I think AMD currently is way overvalued. They should be You can see here, I have them at 200. You know, if you give them a higher multiple for their earnings, because they do have higher earnings, they're growing at 40%. So even if you give them a 40 multiple, that jumps up to around 280, 300, but that is still much higher than the 480. Now, if they show that they're going to be making a lot more, then I can easily see this higher. So I would not short or anything, but I am not currently buying AMD. Next up is ELF. Again, earnings review. So previously, oh, this should be way higher, 98. So this was my previous price target of 82, and my new price target is 102. Now, Rode is expanding very nicely, and the ELF Beauty brand is finally growing again, and they raised their guidance in terms of their future revenues. So they basically said from previously, I think they wanted to say for next year, fiscal quarter or fiscal year next year. So I believe they were talking about only 11 to 15%. Yeah, for fiscal 2027, because their fiscal year is not the same as everyone else. So they were saying, I think it was 11 to 15% growth for 2027, and they raised that to 18 to 20%. And I don't believe recently ELF has had anything under 30%. So I can fully see that fleshing out to be around 25, 30%, which is really nice that they're raising guidance. And there was a ton of real excitement in the call, which is what I like to hear when I'm listening to earnings calls, because you can hear a lot in the CEO's voice and inflections about what they actually think about the company. And it seems that Tarang is actually he's very excited about the company and its growth in the future. Next up is Celsius. Their current price is 27. I'm not sure where that 29 came from. My previous price target was 45. My new target is 42. Now, why did that drop? Because basically Celsius said, and by the way, my targets are 1 year forward. Why is that dropping? Because Celsius basically said that they're getting delayed in their distributor stuff. That's getting postponed and delayed. So, you know, yeah, so the 1 year out estimate, because their revenues are not expected to be as high and their operating income is not expected to be as high, which is the two main things that I look at. And their operating margin, I believe they said that they're going to return to 51% only in 2027. It's currently at 48%. We can look at that here. You can see their operating margin, 393 divided by 817, is around 48%. So it's not going to go above 50 until 2027 again. I believe they said that. So that's dropping my price target. But, you know, the stock is at 27 right now. That is still significant upside. And even with all the downgrades recently, Wall Street also thinks it should be at 44, which is right around where I have it. And again, I do not look at these price targets when I'm making my own price targets, but I do like to make sure that I'm roughly in the same ballpark after I do it so that, you know, I see that I didn't make any mistakes. So that is very possible. Now, the earnings looked really bad. These earnings look abysmal, and that's why the PE ratio currently is 110. Now, what I like about TradingView, by the way, is that they do adjust for things such as distribution termination fees. So I'll show that in a second, by the way. This line right here in the other expenses, this is not just regular other expenses. So this is Celsius had to terminate the distributions for Alani Nu and for Rockstar when they acquired them from the previous distributor. And so now they're moving on to PepsiCo. So Pepsi, the company, the one that makes the soft drinks, they are now the distributor of all Celsius products. And so Celsius had to pay the fees to get them off the previous distributor, which is where all this came from. And I believe there's only like 8 million left there, maybe even less. So this is going to be stopping max Q3. This is Q2. So max Q3 earnings, we're going to stop seeing this, which means that their operating income is going to skyrocket again. It's going to, you know, add 80, that's 150. Add 4, that's 142. Add 80, that's 100 and something. That's also 150 roughly. So they're going to go back to being around 150 per quarter. Hopefully it's going to grow. And you can see here that this is getting hit because of that huge hit in the operating income loss from the other operating expenses. However, you can see here that TradingView, they actually adjust for this. So without these expenses, which by the way, PepsiCo is paying them back. So it's not that Celsius is paying it and that's it. Celsius is going to get refunded from Pepsi on this amount. So you can see that Pepsi, Celsius said 0.14 and they reported 0.36. And this is all adjusted based on TradingView. And you can see what was the quarter that did really, really bad. Celsius reported negative 0.27, and that was Q3 2025, which would be here, I believe. Yeah, it would be here. And, oh, they did not actually adjust that, but they should have adjusted it. So while it did look really bad, it's not that bad because I look at the underlying company and not just random fees that they need to pay, which they are getting refunded for. So I don't see anything in the core thesis of the company that's changed. And I think that they're going to start growing the Celsius brand properly. They said that they're going to come out with 16-ounce cans. They're going to attack that market. And they're also going to focus on growing Alani Nu and Rockstar again. So I think that Celsius currently, that's an easy buy in my opinion. It's very undervalued right now. And then, so the big news with Celsius, which just happened, I believe, on Friday, which is, so Celsius dropped after their earnings from 29 to 23.75 it closed, and even went all the way down to 23.44. And then the next day, so Friday, this was on Thursday, on Friday it jumped back up to 27, high 27s, and it's back down to 27.40 roughly, but that's overnight. I don't count overnight. So high 27s right there. And why did that happen? If we move to 15-minute, we can actually see exactly when the Rockstar CEO talked about it. So this is just a natural rebound right here. That's a natural rebound after a really hard day, which again, I believe this was not warranted, right? This does not make any sense to me because the core thesis of Celsius hasn't changed. It's not that it's worth now only 24 because the company is going to be bringing in multiple billions in per year in revenues and in income, right? Next year, they're going to bring in over 600 million, probably closer to $750 million just in income. So I don't see this as a real value right there. And the revenue that is real, you cannot funge it. It's not fungible. So the revenue, their market cap is only 2 times the revenue. And, you know, their closest competitor, Monster, that's almost 10x multiple right there. So, you know, if we're just looking at revenues, Celsius is probably worth 5 times what it is right now. I don't think it's worth 5 times. I think it's worth around 2 to 3 times, like I said. So this right here, what happened? Sorry, I'm bouncing around. The Rockstar previous CEO, the founder of Rockstar, Russell, his previous name was Russell Weiner and his current name is Russell Savage. He changed his name. And he founded Rockstar in 2001. And this was in a CNBC interview that he did. So he basically bought 4.7% of the company already. And he was saying that he wants to be the new CEO. He thinks that Fieldy, which is the current CEO of Celsius, is doing a really bad job. And I don't think he's doing a really bad job. I think he's not doing a great job. I think he's a bit asleep at the wheel. I just don't think he's really that bad like people are saying he is. But I do not like his earnings calls. He just reads off a paper. And when people ask him a question, he reads off a paper. Regardless of what the question asked, he reads the same thing. And I don't like that. That shows he's not confident in himself. And I'm not sure Rockstar CEO is any good, I'll be honest. But he did found Rockstar. And he sold them to Pepsi for over $3 billion back in 2019, I believe it was. So I'm unsure of him, but he did do a good job. He has previously sold to Pepsi, and I think as a shareholder in Celsius, you know, if Celsius sells off to Pepsi, I'm not mad about that because I'm here to see Celsius succeed. And I think Pepsi can do a better job than their current CEO is doing because somehow he is tanking the stock every single earnings because his earnings calls just suck. So it appears Wall Street really likes the Rockstar CEO, so that is going to increase the volatility a bit. So we'll see. But yeah, I think it's going to rebound roughly to 30. I'm not sure it's going to keep shooting up because 30 is where it should be trading up until it starts showing more revenue, and then it'll slowly rise up to what I believe is the price target of 42. SanDisk earnings. So they did well. They had good earnings. However, it wasn't great. The main thing that I noticed when I was listening to the earnings call is that demand is incredibly high. They still cannot support it. They cannot build fast enough. But there's not too much new there, right? We're expecting these numbers already. And these numbers currently, I mean, these multiples are really low. Forward PE of under 6, that is tiny. And I actually did run an analysis, and the average forward PE during good times and during bad times it's actually higher, but the average forward PE during good times is around 8. So I think it has quite a bit to fill. Even if its forward PE rises up to only 8, that's still 1,400. And I fully believe that the stock is worth around 3,000. That's just what I believe. You know, if I'm wrong, I'm wrong. And it looks like some Wall Street estimates do agree with me, and the average is around 2,000. So I think SanDisk is an easy buy. Now, one thing to notice, and I wrote this down because, see, I forgot, but most of their earnings increase was 2/3 of it was them raising prices. However, 1/3 of it, I just wrote 1/3. 1/3 of their earnings increase was just demand increasing. They rose by 371%, meaning over 100% gain in revenues is attributable just to demand increasing, not even to price increasing, which is absolutely insane. I don't know any other stocks that are doing this right now, and it's just growing every single quarter, and I don't see it stopping anytime soon, and their margins are getting better. SanDisk, Micron, SK Hynix technically, even though after their previous earnings call, I don't love them, but these stocks are going to fly. They both probably have, both SanDisk and Micron, I think they both have an easy 2x from here, but we'll see. Again, I'm pretty heavily invested in both of them, but this is not financial advice. Texas Roadhouse. I did not preview them. I actually never actually made an Excel sheet for them until this weekend, actually. And my price target for them is 230. Their current price is 212. And it appears that the market, TXRH, it appears the market agrees with me. And by the way, this 230, that wouldn't have changed regardless. Maybe it would have been 220 without this previous earnings, but you know, that doesn't really change. This is year to date for them. 174 to, that's around, 25% increase year to date. Oh, it says right here. Yeah, 25%. I think the market likes Texas Roadhouse. I see no reason not to. They are consistently growing every single quarter at 11%, and the future growth is not estimated to drop anytime soon. So I think that's a great buy if you just want anything stable. I think Texas Roadhouse is great, and I do believe they actually also have dividends. So if you know you're a dividend investor, yeah, they do have dividends. It's $0.75 per share, which at 175, that is 1.7% yearly, roughly. It can be closer to 1.5%, you know, but that's something. I think Texas Roadhouse is pretty great. However, you do need to realize it has been cyclical, where it has peaks and troughs roughly around June through August and in December, like end of December. It has peaks and troughs. I am not saying you should trade that. However, just be aware that currently it has technically at a peak, and so it might come down to 180, 175 down here. I wouldn't be surprised if it does. Again, I don't read charts like that. I don't try and guess what the market's doing, but that is historically what it has done. But I do think Texas Roadhouse should be moving up steadily from here, and 25% yearly for an 11% growth company. That is perfectly fine in my opinion. Oh, it even says here, see? I don't need to calculate anything. It says a 1.44%. Perfect. Now, Shark Ninja. Yeah, I would not currently buy Texas Roadhouse, but it is on my watch list, and it is a solid stock if you just want a solid stock. Shark Ninja Show. I was super huge on them last year. I believe I even bought them during this challenge. I was super huge on them when they were like 80. Maybe April of last year it was. Maybe May, I forget. Yeah, April of last year, they were, it even hit in the 70s. So I was saying that it's going to hit 120 back here, and it did hit 120 actually pretty soon, before the end of the year. And it's just been a bit cyclical, up and down to 100 and 130 for a couple of years now. And it finally broke out. Now, I've been saying for a while that the price target was 160, and it's been slowly climbing up, 170, 180. It is now at 190, which is under their current price. So I do think it is a bit overvalued right now. However, I do like the company. I think they are a phenomenal company, which is highly innovative, which I love. They are both, so Shark Ninja, Shark is the house cleaning products, and Ninja is the kitchen products. So Shark Ninja, you probably have a vacuum of theirs, or if not, you have the Ninja Creamy, in case you aren't aware of what they do. Their forward PE is 26. That's fine. That's S&P 500 average currently. I do not look at current PE, and it appears that my 190 is within the price target of Wall Street. So I am perfectly fine there. Now, it does not look like their growth is slowing. Their margins are improving. And I wrote again that they are hugely innovative. I love the company. Again, this would be a super long-term hold. Currently, it is a bit overpriced. Now you can see that their margins are steadily increasing and their revenue is growing at a decent clip. I'm not sure that this 20% is sustainable, but even 15 to 20%, that is perfectly fine for a growing company. And you can see their operating margin is growing roughly year to year, almost every single year. Trailing 12 months would be a better view for this. And you can see that their operating income is just growing significantly. And roughly, probably next quarter, it's going to cross the $1 billion for the first time. Now, looking at the net income, like I said, this will cross 1 billion this year. And the market cap is 26 billion. I don't look at that too much, but take it for what you will. I like the company, not the current price. Now, Oklo. So Oklo is a funny company. I love their CEO. I think he is incredibly smart. He is very smart. When you listen to his earnings calls, he will get into the deep technicals, not only of the financials, but also of the business itself, of the science behind what they do and what Oklo does. So Oklo is a fission company that is supposed to provide small localized plants, not like the tiny plants, but small localized plants for areas where you don't need a huge reactor. Now, one of the news from the past week about Oklo is that they achieved criticality on their Groves plant. Groves, Oklo. See, Oklo's Groves reactor achieves first criticality, and this is directly from Oklo. And this is, just to put this into perspective, criticality means that they are receiving more energy than they put in to start it, because they're now using uranium and plutonium. Oklo has this thing where they're using around 10% plutonium with the uranium. I'm not entirely sure about the physics and the math behind it, but it is a way. I think they said something about efficiency during the call. I'll be honest, I blanked during that part. But they did all this. They built it from scratch. This was land that they bought that did not have anything built on it. It was not a previous reactor. It was not anything. 11 months. That's how long it took them. 11 months from buying land until criticality. That is insane, which means they now have deals with NVIDIA, Meta, Microsoft. I believe that's it currently. Maybe NVIDIA, Meta, Microsoft. Yeah, those three. Those are the three big ones. And I think the US government as well. And so if they can build a plant and reach criticality within 11 months, and the next one is going to be quicker, they already said that. If they can reach criticality within 11 months, that means that this revenue right here, which we're looking at right now, income statement, they are pre-revenue right now. They are not bringing in anything. This can skyrocket in a minute, right? If they are making deals to produce localized power for the data centers for these big companies, this will skyrocket. They will start bringing in multiple billions per year, and the current company is worth only $9 billion. I think this is a company that has a huge future, and I currently hold both in this and in my real portfolio. I hold a uranium ETF, and the uranium ETF holds a lot of Oklo currently. But I am debating actually, even for a pre-revenue company, regardless of profitability, I think that the upside is just enormous. This is enormous upside for the company, and it's worth, in my opinion, again, not financial advice, I think it might be worth dipping my toe in, because this has literally 10x potential, probably within the next year and a half. And I think Wall Street also sees that, because even though they're pre-revenue, they are not making a single dollar currently. I'm not even sure where this 121 is coming from, probably a government contract. They are not bringing in money. But their balance sheet is growing. Their net cash is growing a ton, and that is mostly from selling shares. You can see here the shares are rising every single month. 163, 146, 9, yeah. So they're mostly selling shares to grow the balance sheet. But this stock can switch. It can flip the switch in a second. So I am very bullish on them. And honestly, mostly because of their founder and CEO. He is very smart. He knows what he's doing. We can look him up really quickly. Oklo, founder and CEO. Yeah, Jacob DeWitt, this guy. MIT. Yeah, PhD in nuclear engineering from MIT. You can't make this up. He knows exactly what he's doing. It was a pleasure listening to the earnings call. I highly recommend anybody who has the chance to do it, go listen to the earnings call. It is eye-opening, I think is the term I'd use. I came out incredibly happy to put my money into that. I have not yet, but I'm trying to figure out ways to move it into my portfolio right now. And again, this company can fail, obviously. It can fail. But I think it's worth the risk for a 10x opportunity. Okay, so now my portfolios. Oh, I did want to talk quickly about the GameStop 1.4 billion convertible exchange. So what's happening with GameStop? This came out on Monday, I believe. Yeah, that's Monday. So GameStop announced that out of their $2.4 billion in convertible notes that they currently have, 1.4 billion, they are currently doing, they are selling shares to them, basically. That's what's happening. So they're going to get out more shares, sell shares, dilute, if you want to call it that. They're going to dilute GameStop in exchange to reduce 1.4 billion from their debt balance sheet. So GameStop has both a pretty big debt, but also a pretty big cash balance sheet. You can see here cash and cash equivalents of 83.68, and this debt right here of 43.38. Yeah, around 4 billion. So 1.4 billion, that's going to drop to 3 right now. 1.4 of that is going to go into shares, basically. So that's going to drop. This is going to rise to 5.4, roughly. Again, it depends on how their eBay stock is doing. What's going on here? So for 35 trading days, not 35 days, so 35 trading days, which is 7 weeks from August 3rd, the VWAP, the value weighted average price of GameStop, so you multiply the end closing price by the daily volume, and then you take the average of that throughout these 35 days, that is going to be the average price for which the convertible notes, these people, the private exchange, the private equity, that's the price that they're going to be paying for the GameStop shares. Why would the company do that? Why would this private exchange do that? Because they believe that they're going to make more on their money. Well, actually 0% convertible notes, meaning 0% interest. But they believe that GameStop is going to be worth significantly more. And why would it be worth more? Because, well, first off, the company is growing. I think GameStop is worth $29 currently based on my prices. GameStop, their operating income is rising every single quarter. This is a Q1 right now. Q1 is generally a pretty weak quarter for GameStop. It's not Q4, and this is rising, and it's going to keep on rising because they're doing phenomenal. Ryan Cohen is doing a really good job with them. It is currently only worth 8.6, and out of that 4.6 is their net cash minus their net debt. So, the whole company of what it's doing is worth around $4 billion, and they're bringing in $3.7 billion in revenue with an income that's going to be worth about $1 billion in a few months. So that just doesn't make any sense to me right now. I think GameStop is worth a lot more. It's worth around 29, probably even close to 30, 32. And I believe the private equity here, the private exchange, I believe that they think the exact same thing, which is why they want more stake in GameStop. Now, why did the price drop when they said that? Not because it is bearish. Because we are taking into perspective another $1.4 billion in dilution, which again, I do not think dilution is a bad thing for GameStop. I think that GameStop knows how to leverage their cash, but it is dilution. And also, while GameStop is not allowed to buy back shares during this time, the private equity, the private exchange, they are allowed to short shares during this time. So they have every incentive during these 35 days to make sure GameStop is under whatever price they want. There is a price floor, meaning it cannot just drop to 12. I believe the price floor is going to be around 19 or 18 and a half, just because that's what it's been hovering at. And it is probably going to keep hovering at that price, even past earnings, because I believe 35 days is, that's going to be September 22nd. So during earnings, we'll see what happens. Historically, GameStop does rise previous to earnings. We'll see what happens with these earnings. I believe GameStop is going to bring out amazing earnings. And I'm not entirely sure what GameStop is getting out of this, I'll be honest. Maybe it's just to clean up the balance sheet. Maybe they want to get rid of all their debt before they make an eBay bid, because once they make an eBay bid, they need as much leverage as they can get. So I believe that they're trying to get more cash into them, less debt, and then they can leverage more into eBay, because eBay is not going to agree to anything except for straight cash probably. So yeah, I am very long-term bullish on GameStop. This right here, this is because of what just happened. So the price dropped to 19 point something. And so my leaps for 2028, they dropped from 650 to 450, which significantly dropped the price. However, I am still selling covered calls at roughly 12 to 15. This was specifically pretty low because it was my bad. It was actually at 11 supposed to be. Never mind. And so when you do the math, this brings in more shares per the price that we're getting compared to when it was at 22, roughly. So I fully believe that GameStop, my goal is to reach this 250 by the end of the year. If we're at 250, GameStop's at $5. This is going to be around 5, and we're in business. We're going to be at 120K right there. I am very bullish on that. My goal is 250. I am not worried about the current price of GameStop. Next up. Okay, so my portfolios. We can go here, dashboard. So main portfolio. We are up 46% on the year. We have just locked in profits on ELF. I could switch everything to the S&P 500 this year, and I will beat my goal for this year was 35%. I said I would probably make between 35 and 50%. Currently, we are at 46.1%, which is amazing. I am very happy with that. Now, that is with almost 2 times beta of S&P 500, meaning almost 2 times risk. However, even risk adjusted, both the downside and risk adjusted sharp, we are above 1 and above, 2 and 2.7 is amazing. So I think this portfolio is doing phenomenal. I am very happy with this portfolio. And now I have $36,000 in cash where I need to think about what I'm going to do. And, Oklo is probably going to be one of those companies that I'm going to buy. And I believe my next one, so you can see here, $33,000 or $36,000 in cash right now. I'm probably going to put more into Micron and SanDisk. I'm not going to touch TSM. I will probably put in more into Celsius. Robinhood, probably not. ELF, too expensive currently. Microsoft, I might add some there. And I'm going to probably open a position in Oklo. But we'll see. The meme stock portfolio, again, we just talked about that. That is a GameStop poor man's covered calls. We can see here how I am compared to my simulations. The 25 percentile is at 91. I am at 72. But like I said, I am not worried. And bringing this up again, my average options is at 220. 220 should be easy to reach. We're at 165 right now. That is a distance of 60 over 20 weeks. So that's an average of 3. 3 should be easy to, 3 should be easy to do every week. So we're definitely going to beat the 216. Hopefully we can reach 250. If we reach 250, I will be happy regardless of what the price is, because that is a ton of income every single month. And if you even just do $10 on 250 for the rest of the next year, 250 times 10, that is 2,500 every single month for 50 months. You are talking about 130K just in income for next year, regardless of the GameStop price. So I'm happy with that. Deep value portfolio. So this is the Meta one that we just did recently. You can see here, sold the Meta put for 35.50. Celsius, what happened here? I'm not sure what the Celsius is. I'm not supposed to be holding Celsius here. Oh, did I buy Celsius when it dropped to 24? That's funny if I did that. Not the right portfolio. Oh my goodness. Okay, not the right portfolio. But you know what? Goodbye. That wasn't the point of the deep value portfolio. I'm sorry, that was not supposed to happen. That's actually funny. Okay. Deep value portfolio, 26% on the year, 1% over the week. This beta is currently not relevant because this is only a 2-week-old on the Alpaca. I was previously doing this on Excel. So yeah, there's that. My current holdings are Micron, Gen, Amcor, Celsius, LED, Trading Desk, SK Hynix, and a bunch of other small ones. Again, this is just math. I'm not supposed to be controlling this, and this is supposed to be just forward PE math with some guardrails. And hopefully it should beat the S&P 500. And it might. The S&P 500 is looking like it's going to recover pretty big for the next few months because there's a ton of good stocks there that are undervalued based on their performances and their earnings. So I believe that's it. Yeah, you can see here. This is my main portfolio. Meme stock is meme names, and the deep value is that's just math. Okay, I believe that is it. Thank you guys for listening. Good luck this week. I'll see you guys next week. Bye-bye.